Here we go then. Another Friday is upon us. Last one of the year, gents. Last one of the year. It's been a busy few months. Plenty of webinars in the diary, and I know yous have been pretty busy as well in the lead up to Christmas as well, haven't you?
Yeah, it's been pretty swamped. It's definitely looking forward to some well-earned break over the Christmas period and then getting back into the new year.
Yeah.
Full steam ahead.
Quick question: when is the out of office on officially? When do you put that on? Is that this afternoon, or are you going to be, tentatively replying to people over sort of Monday and Tuesday next week?
I had to ask someone. So I started the business 4 or 5 years ago, and I had to remind myself. Went on holiday 3 months ago of how to use an out of office because it hadn't been a function I'd used for a few years. So I'm not brilliant at the out of office, but definitely downtime over Christmas because it's needed. Yeah.
And you weren't very good at that one either because you still did a webinar from Italy.
That's right. We did, didn't we?
This is the problem I have. For me, I think over Christmas, I think what's the point of putting the out of office on? No, everybody knows they're not going to get a response from me on Christmas Day or Boxing Day. Depending on how urgent it is, I might, reply to you in between the two. But people understand, right? Not much business gets done this time of year.
Yeah, no, 100%. It's I think we've spoken this year actually, and there might be a few people on this webinar today and watching it live afterwards. That we've spoken to quite a few new business owners this year as well. So a lot of them have realised Christmas is probably not a time for relaxation and rest. A lot of them it is doing things like this, looking at their CIPs, getting their ducks in a row for next year.
Yeah.
So yeah, everyone has their own different preferences, but yeah, just always remember to take the breaks when you can because otherwise you'll burn out really quickly.
Yeah, absolutely. Look, 2 days won't impact your business, right? You can have your 2 days to yourself, and it's still going to be there when you come back anyway. So. And I know I asked you guys before, but are you back on the 2nd? Are you back on the 6th? Because I'm getting a lot of out of offices saying they return on the 6th. Where are you at with that?
2nd for me personally.
2nd, yeah. Well, of course we are. I've got a meeting with you, so you better be back. Right, so we've got a few people in here. So what we'll do, we'll get started today because it's a good session. I'm looking forward to this one. So just, thank you for everybody that is joining us again live. And for those that are going to be watching it on demand, it is the last webinar of the year. Part of me is pleased for that. Part of me, it's going to take a minute to get back into it in the new year, but we're going to be kicking things off again on the 10th of January with our webinars. So as always, we've got a few housekeeping notes. The session, we do plan to run for about 45 to 50 minutes. There's going to be some Q&A throughout as well, so feel free to drop any questions in the chat box. I know Amanda and Jade have already dropped a message. Amanda's out of office is on from 12 p.m. today. That's unbelievable. We'll be having a call after the webinar. We've also prepared a couple of interactive polls as well, so to try and give you some responses from others that are in the room. So let's jump straight into this today then, guys. I'm Lee, co-founder of the Financial Planning Club. If you are a business owner looking to take your business to the next level, the club offers a tailored membership designed just for you. So we provide everything from strategic planning to focused 90-day accountability sessions, helping you stay on track and working towards your goals. And for everybody, we have the community. So this is a completely free and hosted on WhatsApp. It's split into 5 specialized groups, which is your financial advisors, your mortgage advisors, your power planners, your ops managers, and your business owners. And it is all about peer-to-peer technical support. So it is a chance to upskill alongside like-minded professionals as well. So whether you're here as a member today or just exploring, we're glad to have you with us. Just touching on the club briefly. So the club part of the business, it is for business owners. It is a thriving community of business owners that are leading the way in financial planning and trying to make a real difference within their business. Everything that we do centers around accountability and collaboration. It is about being a part of something a little bit bigger. So if you are ready to implement fresh ideas, we will support you with creating clear business plans, setting those ambitious goals. We'll surround you with a supportive network of like-minded individuals on a similar journey, and absolutely we'll be holding you accountable every step of the way. So grab some time with us and the club to see how we can help elevate you and your business, most certainly into 2025. This is a really cool tool. You'll get an email about this at the end of the webinar. It's our scorecard. It's a fantastic resource that helps you identify areas of your business that might need a little extra attention. We all spend so much time working in our business and not enough time working on our businesses. So taking a step back to assess and reflect is key to growth and improvement. So as I said, we'll send a quick email out. I think there's about 15, 16, just some multiple choice questions on there. It will just highlight 4 different areas of the business, and we'll send you back a personalized report as to how the club can fit in and help. So keep your eye out for that email as well. Just on the community, as I said, we've got 5 different groups. We've been hosting it for over 2 years now. We split it into groups because we wanted to keep the conversations really relevant and really focused. People love being a part of something bigger, sharing ideas, tackling challenges together, and connecting with others who do really understand their roles quite well. So that's really good. Best part about it, look, someone has been there, done it, got the t-shirt, and they're more than happy to share their experiences with you. So if you're not involved yet, you can join on our website under the community slot. And I know there's a couple of messages going in the chat now with links that you can absolutely click and join. But again, don't worry about too much. We'll send you an email about that as well. Our collaborators, Aspen, are here with us today, and we couldn't do it without the amazing support of all of our collaborators. So from platforms to compliance, recruitment to training, websites, marketing, mystery shoppers, and everything in between, our collaborators do play a real fundamental part of supporting our club members and the journey that they are on. So again, big shout out to all of the collabs here for supporting us and our club members. We are back. We are on the road in May 2025, May next year. So along with our quarterly business owner roundtables, our face-to-face event is kicking off in May next year. So we're going to get the tax year end out of the way, and then we're going to focus on making your business future fit for 2025 with a real growth mindset. So typically exclusive for club members, but we always allow for a small allocation of non-club members to come and join us on the day. So if you are interested in that, at the end, there will be a little survey asking you about the speakers, the content, and whether you want to be involved in the club and our events. So again, that will be on the survey, and we appreciate any kind of feedback as well. As I mentioned, today is the last webinar for us. Thankfully, Amanda did try to squeeze one in very early on into January, but nobody's going to be around on January the 3rd. So our first webinar kicks off on Friday, the 10th of January, 10 o'clock. It's the same slot, just a different week. Technology is absolutely transforming the way that financial advisors approach financial planning. And the webinar that we've got with Timeline explores how cutting-edge tools can enhance your practice and improve your client outcomes. So as always, register for that on our website to attend live or receive your copy of the recording. And then we are back with these guys. We're back with Aspen again. The content that they're delivering for our club members is absolutely amazing at the moment. What they're doing is very different, very innovative. So keep an eye out for this webinar as well. This is on Friday, the 17th of January, again, 10 o'clock. Building high net worth propositions with core and satellite investing. So again, same place. You register for your webinars and re-watch any of our webinars all on our website. So that's enough about me. Let's talk about Aspen. So Andrew founded Aspen in 2019 with the aim of transforming the MPS market for a best-in-class digital experience for advisors. And you'll see Aspen's tech in action towards the end as well. Lewis has a background of working for some of the largest names in the financial advice industry. Lewis joined Aspen and the team back in 2023 with a shared vision to build and grow something completely unique that evolves financial planning. So guys, that's my introduction done. Over to you. Andrew, I think you've got full permission to share your screen. So happy days. Over to you.
Great. So I'll just put this on.
I'll stop my share.
Is that all good?
Yep, we're good.
Fab. All right, morning, everyone. Friday, the 20th of December. There's probably a few hangovers in the room, so we'll keep it light today, yeah, very much looking forward to 35 minutes of chatting about building a CIP, central investment proposition, for your business, or evolving your CIP. So a bit about so myself and Lewis, with a very kind introduction prior to this. So yes, I started the Aspen business about 5 years ago. Previously with a couple of wealth businesses in Edinburgh and London for 15 years prior to starting Aspen. And I'm sure everyone's used to or familiar with the fact that there's a lot of MPS solutions in the market, and coming into this arena, it was important for me. I felt there was an opportunity to move the MPS landscape forward a bit, and so that's what I feel we've done with Aspen. We'll touch on that a little bit today. Lewis?
Yeah, brilliant. Good morning. Also, I'm Lewis Brasseaux. I'm head of strategic partnerships at Aspen. So yeah, as we mentioned, joined the business back in 2023 now. Yeah, previously I've worked for some of the largest names in financial services. So obviously Aberdeen, obviously one of the largest platforms out there at the present time, but also used to work for one of the largest wealth managers and financial planning firms, not only in the UK, but actually the world. And they've been operating what we now class as a centralised investment proposition all the way back since 1995. And that's probably one of the best versions I've seen of truly building something that can really help scale your business. So yeah, some of this today is taken from that and helping you sort of build your CIP that caters to various different client needs, and yeah, can really help your growth in 2025.
Grand. So just a little bit briefly about Aspen for those that don't know, what makes us a little bit different in the market. So we are purely a provider of MPS solutions, but a lot more than just your risk-rated range of model portfolios. We offer probably the broadest range of portfolios on the market across risk, style, and our unique satellite portfolios, which we'll touch on today. We have spent a lot of time in the last 5 years building a great tech experience that's really intuitive and simple to use, that really encompasses the whole investment landscape. And then finally, service is acutely important to us. So firms that work with us can really consider us an outsourced investment solution for their business. We fully recognize the importance in service, and everything we do is geared towards looking after and supporting financial planning businesses. So a few of them, those are our three kind of key areas of difference, and we'll touch on some of that today. Yes.
Brilliant. Yeah, so today what we'll cover off effectively is number one, building your CIP from scratch. So this is around understanding your target market. What do you want from your CIP, and what options available are there? This is something that we keep coming up against sort of time and time again when we're speaking with firms. What they're really wanting to understand is how can they build a CIP that caters to various different client scenarios and client types. How can they make something that maybe fits in with their risk profiling, fits in with their technology they use, and how can they give clients what they feel is really tailored outcomes, but in a really scalable way? Obviously, MPS has been a dominating force for a couple of years now in regards to the investment landscape. So going to have a specialized area on that later on, just to sort of go through what to look for from an MPS solution when you are conducting your due diligence. And then we're going to do a case study of a CIP in practice with a particular focus on how you could potentially use this for retirement clients, especially for those that have done any work recently on the FCA's retirement income review and trying to build a CRP. So that's something that keeps coming up time and time again as well. And then what we'll do to finish that off with the case study, as Lee mentioned, is bring that all together with the use of technology, so you can actually look at how technology can really transform your business and enhance that CIP experience. And then we've got a bit of time at the end for Q&A as well.
Nice one. Lee, just jump in with the polls when they are.
Yes.
I can't fully remember exact slides they come on, but just
I've got them. I've got them. So as soon as we come onto it, I'll throw those up.
Yeah, and also any questions and throughout, just please ask the Q&A box. Be more than happy to answer those for you as well.
Nice one. So in building, so yeah, this session focuses on building or evolving a central investment proposition. So when building your CIP or trying to have a bit of a refresh of it, the critically important thing is to really understand your target market. And so we've got a few options here of what your target market really is. I would say a lot of firms fit in this camp in terms of holistic financial planning. A range of objectives and goals from the clients, and a range of sort of demographics of clients, from young accumulators to those in retirement, including lower net worth clients, higher net worth clients, those with simple needs, and those with more complex needs. So this is obviously the most typical camp, and quite often in this camp, more than one solution may be needed. Then we go into the sort of subsects. So retirees, obviously there's a large amount of wealth in this camp at the moment. Typically relatively risk averse in some ways, in terms of avoiding kind of big drawdowns and avoiding sequencing risk in retirement. Can have slightly more complex needs. You have your sort of three pots in retirement. You have your immediate liquidity, your sort of lifestyle 2 to 7 year period, and then any sort of longevity of the pot or legacy that you would like to leave. Then there's the sort of wealthy families, high net worth or ultra high net worth, can have slightly more complex needs and tax or varying goals and time horizons. Sometimes here there's a slightly more involved solution that's perhaps needed. Not always the case, but sometimes. What we'd call the mass affluent, or sometimes with simple needs. Here we want quite a scalable solution for these clients, and then the accumulators, young, growth mindset, minimizing cost drag, these sorts of things for that. First poll is up. Yeah, so it's good here just to understand in the room in terms of what the general target market is for people.
And I remember last time, guys, I think there was one question on here where people probably fell into one or two camps. So I think I made all of the questions multiple choice as well, so we might be able to cover. Because people, I can't remember what question it was, and it will remind me when it comes up, but they sat in both parts. So
right.
I thought if we put a multiple choice on, then we can.
Yeah, that makes sense.
Do that.
Something that has come up as well recently when we've been having conversations with firms is, do you need to necessarily offer something for every single client? The answer is no, you don't. You can basically do this for your target market in particular. The FCA are more than happy with that. You're saying these are the individuals we work with, and we won't work with anyone outside of that arena. That's absolutely fine. So don't feel like you have to have a solution for every single possible client that walks through your door. The only time you're going to potentially need that is if you are generally looking at offering holistic financial planning. But yeah, it's one of the common misconceptions that we speak with advisors about on a regular basis.
Yeah, we also see it from an advisor's perspective as well, where they're really doubling down now on their niche, being a little bit more selective over the clients that they want to work with and the clients that they want within their business. So, and that something like this enables them to do exactly that as well when focusing on those clients, doesn't it?
Yeah. So now you've sort of identified your target market, which you will know well, understanding your business, and then you need to think about what you want from your CIP. So the first thing is to consider: do you want to do it in house, or do you want to outsource the investment solution? Clearly, in the last 10 years, we've seen a move more towards outsourcing. But what are the benefits of or not of each? So I'd say in-house you have more control over things. There's potentially more perceived value to the clients from the financial planner, but it does come with a lot of admin and general responsibility, as well as having that sort of dedicated research function. Outsourcing, you have the facility to pass on the responsibility. Obviously, there are people dedicated to looking after things in that field, and you have the ability to hire and fire. Clearly, if you're doing it in-house and things don't go brilliantly, you have no one you prefer not to fire yourself. So And it also finally kind of gives you the time to focus on planning. So I think it's reasonable that there has been a move more towards outsourcing than in-house. 10 years ago, the low-cost solutions in the market weren't as prevalent and available as they are now. And so outsourcing was quite expensive 10 years ago, but now you can outsource for fairly cheaply. So it kind of works pretty well these days. You want something that's super easy to communicate and understand. Clients need to be able to understand what they're invested in, and with that, advisors need to be really confident in terms of what they're presenting. And so I think something simple, clean, and clear to understand is really important. A repeatable process around what the CIP does is important. It allows your business to scale. It means that the FCA, if they were to come in, or compliance or whatever, is confident that you have a process in place that works for a broad spectrum of clients. And if you have multiple advisors in your firm, it means consistency across sort of the advisor and client bank. Reliable performance. It's always tempting to look for the top performing thing over the last 1 or 3 years. But I think probably what's most appealing for clients is something that endures over the long term. And so this is across the risk, the low risk to the high risk, and across the style spectrum if you're using an income or sustainable strategy relative to a core or passive strategy. So I would caution always looking at the best performing thing over the last 1 year, and look at something that's endured over the last 5, 7, or 10 years. The good thing about the last 4 or 5 years is you've seen lots of different environments, so it is quite a good a period for assessing performance. Something that's cost effective. There's obviously the cheapest possible option versus something perhaps that's a little bit more expensive that you perhaps get more value from. So have a look at that when you consider cost versus value received for the end client. Service and tech delivery and the actually underlying investment product also is value. And then tailored to your market. So coming back to the target market point, a solution that fits really well with your client base is clearly important.
Just going to run another poll, guys, about what's important to the people that are attending, and I think this was the one that was a multiple choice that made sense.
Yes, this is one I'm always quite interested in.
Where do you typically see the responses? Do you see a pattern?
Yes, yeah, it's a really good question, actually.
I'm pretty sure when we ran this last time, I was surprised at the outcome. Yeah.
I feel like most people that we speak to generally are really more about, especially the clients that we work with mainly, they're more about investment philosophy and client understanding. They really want clients to be invested in something that they understand and can get behind. We typically deal with a lot of firms that operate in the sort of retirement space and sort of the high net worth and ultra high net worth space as well. And for them, giving them something that the client can actually understand and aligns with the client's own investment philosophy as well as the advisory firms, it's something that we keep seeing come up time and time again. I think gone are the days where people sort of pitch performance. They don't really tend to sell products anymore. And where we're moving into this sort of more financial planning based world now, I thought performance is coming up less and less. And I think 2022 being a good example of that. If you look at someone like a Vanguard Life Strategy, who was one of the top performing investment solutions prior to that, obviously had one of the worst sort of portfolio drawdowns in 2022 in particular. You can't always be led by performance, which is something that obviously we talk about time and time again, but obviously there are a few evidence points when it then does happen.
It was Vanguard more on the low risk side of things. They did fine on the high risk, but on the low risk side of things. So but at the end of the day, you need to have something that you need to believe in, and that's the most important thing. If you've got confidence in it, then clients will. Okay, so what are the options available then for your CIP? So you've got traditional discretionary. My personal view is that this is is sort of dying away a bit. What are the sort of benefits of that? I suppose you feel like you're getting something more personal for the clients. The reality, having been in a big wealth manager, is that the reality is a bit different. That at the end of the day, these big businesses are trying to get people more in sort of model aligned portfolios, and so I'm not sure that's really there anymore. When I started in the industry, I worked for a big wealth manager 17 years ago, and yeah, I think people did get a pretty personal portfolio. Whether that necessarily performed better or worse is a different matter, but it was a genuinely kind of personal portfolio. Tax was managed and these sorts of things. But I think traditional DFM is probably in a bit of a decline now. I would say it does still have value where there is something particularly unique about the client that they need managed. That might be complicated tax planning, cherished holdings, or specific exclusions that they want. So I would say there is still probably merit in a DFM for that respect. And by traditional discretionary, I mean where it's relatively high cost and someone is kind of picking stuff for that particular portfolio. MPS, the next sort of outsourced solution. You've got two options here. You've got advised, where you could build your own. It's actually relatively easy to build 5 risk-rated kind of model portfolios. You could populate it with 6 to 7 holdings, and that, to be quite honest, would work relatively fine. You can make it pretty low cost. So that is an option available for people if they wish to do that. We do know some firms that do that. Clearly, outsourcing has become more popular, as I sort of said before. There's a lot of choice out there, clearly, and then you need to find 1 or 2 that kind of fit well with your target market. I would probably avoid more than sort of 3 providers in your CIP. I think it just starts to get a bit complicated. Different philosophies kind of not kind of aligning with one another. So I think probably 2, 1, 2 is probably where you want to land if you have the luxury of having that simplicity. Multi-asset funds, perfectly good option. A simple solution for clients, or you can have a blend of multi-asset funds. We've recently launched our 5 risk range of 4 multi-asset funds. It's a nice simple solution. Either you can have 1 fund like a Vanguard Life strategy, or you can have a blend of 4 funds to sort of spread some diversification around. But yeah, this is useful for CGT perspective. And those that just want quite a simple portfolio. I would say that the downside sometimes, and the reasons people don't use multi-asset fund, is sometimes optically one line item of Vanguard Life Strategy 60. The client might think, well, I could just go and buy that on Hargreaves Lansdowne. So sometimes the optics of a single fund, multi-asset fund, can put people off. And then there's ancillary options. You've got smooth funds, like obviously the main one here is the Proof Fund, which has been popular over the years. I do believe that a number of other smooth funds are being launched. I think I can see this being quite a popular area. I think Aberdeen are launching one, and 1 or 2 others. So expect seeing more smooth funds, I think, around going forward. There's alternative fund solutions like a rougher structured products, absolute return funds, slightly less popular these days than they were before. Obviously GARS went to 65 billion and then back down to 0. In the absolute return space, structured products are, they can be useful, but they have their complexities and things, and quite a lot of fees are taken out of them. So I think we see these sorts of things being used less and less. Rougher, I think, is a good business, although struggling a little bit for identity at the moment. But generally, is there's a few out there that are quite good businesses. Then there's the potential for inclusion of private equity. I don't think private equity is quite there yet for the full kind of financial planning piece. I think we're probably a year or 2 away from having a good digital experience for people to buy private equity. The issue at the moment is elective professional upgrades, a lot of form filling, a lot of compliance kind of burdens for private equity. So it's not quite there yet in terms of for the mass participation, but I think we're probably a year or 2 away from being able to include private equity a bit better. And then there's things that you'll be familiar with in terms of VCT, EIS, and AIM solutions in the market. So these are the sort of options available for your CIP. Again, you probably want to pick one or two of these and keep it quite simple. So yeah, we've got a poll running here in terms of what your current CIP looks like. Multi-asset funds, in-house models, MPS outsource, full bespoke discretionary. So yeah, a few discretionaries out there, full discretionary, MPS, multi-asset funds, in-house models. But generally outsourced is looking like it's more popular. Okay, so we're just going to spend a bit of time now focusing on MPS. I'll keep things moving forward, conscious of time. So yeah, I would say with regard to MPS, there's over 100 options kind of out there now. There's an awful lot of choice in the market, and quite frankly, a lot of people doing quite similar things. So for you, you've got to decide on a few that you like the look and feel of, understand those, and then kind of pick one or two. When you're looking for an MPS solution, and I kind of come back to this, it's not always about performance. So coming into 2021, this was a popular balance mandate, the blue line there, versus the MPS benchmark in red for a balance mandate, and we saw a lot of flows going into this particular product. And then after 2021, this was then the outcome for that. So it's really important to understand the philosophy of the process, and sometimes the most recent performance, especially if it's been particularly strong, could raise some red flags. Really, what you want to see is enduring performance through various different environments to kind of choose on performance grounds. And this is another example. This is a low risk passive solution for the 5 years into 2022, and then this was a few years kind of after that. So low risk to higher risk, like it's important to really understand what you're getting into. So next is what makes a good MPS great. So I think a very clearly defined investment philosophy, something that you understand and can get within 10 minutes, and so you'll be able to then explain it easily to clients. A very clearly defined process. The thing I don't really like is what I call finger in the air investment management, where people are sort of pretending like they're knowing what's going to happen in 12, 18 months time, and adjusting the portfolio accordingly. You want a clear process, how it's built and run, so it's understandable for your end audience. Value for money is clearly important. And as I said, value can be more than just the absolute cheapest thing on the market. Service, tech, and your experience is also important in the value piece. But I think undoubtedly, you want the thing to be, certainly the all-in cost to be below sort of that 60 basis points for your core, and then any passive solution you'd want below sort of 35 basis points. So that's kind of where you'd want to be. Anything above that probably isn't needed. Unless it's niche in terms of income need or something like that. Skin in the game, for us, when we're selecting funds, we only have, a very small amount of active funds, but when we are choosing active funds, this is actually one of the things that we look for. How much does it matter that the MPS provider for us, when we're looking at funds, that the fund does well? So I think, skin in the game is pretty important when selecting anything. And great businesses out there, they're kind of founder-led businesses. See Tesla and others. So it kind of does make a difference in terms of the experience you get in terms of service and probably the performance that comes at the end. I think MPS being the core focus of the business, we've seen a lot of providers, bigger firms, kind of fall over themselves in the last 5 or 7 years to launch MPS solutions because they see it as a growing area of the market. Do they care massively about the MPS solution? I don't know. So I think if MPS is the core focus of the business, all resource and energy is going to be put into that. So I think that's probably quite a useful thing. Exceptional service is an absolute must. Calls and emails answered quickly with, useful. You're not being sold to, but you're just given the answer that you need and want. And then, as I said before, reliable performance. So not, incredible performance 1 year and then a disaster the next year. That sort of enduring performance is something you want to look for as well. So for me, these are the hallmarks that makes a good MPS great. in terms of you need to find a philosophy. As financial planners, you'll have a feel for what you believe in, what you like. So it's about there's quite a lot of things that could fall under investment philosophy. The use of passive funds. Do you like the use of active funds? Do you prefer a blend? Do you like a style tilt in terms of a growth leaning or a value leaning? Dimensional and others have done some good work on the factor biases of value, profitability, and size. Do you want some inflation proofing elements, some real assets in the portfolio? What's your view on the use of alternatives in portfolio? Do you believe in asset allocation, strategic and tactical? And what's your views on responsible investing? So these are the things that you'd want to kind of think about as hallmarks for your investment philosophies that you can get behind and believe in. For us, we're on the blend. We believe in factors. We have some inflation proofing. We believe strongly in the use of strategic and tactical asset allocation, and we generally have a sensible, responsible investing framework that kind of overarches us. So that's us, but it's important that you have something that you can kind of hang your hat on and believe in. So once you've kind of decided on that, you then need to create your blueprint of what your CIP is, and so. It's just really clear for anyone in the business or if compliance or the FCA come in that it's really clear in terms of what is your CIP, and really you should be able to fit this on one page. It doesn't need to be, obviously you can have the fuller version, but sketch it out and get it on one page, and so it's really clear. And given the poll at the start, most financial planning business have a variety of clients. So these are typically I can generally put them in three camps. So those that are accumulating or relatively simple needs, a central retirement proposition, and those clients that have more complex needs. I think these are the kind of three buckets that we can probably put 95+% of clients in. So this is then those three buckets. So your accumulators, simple needs. Accumulators, wealth accumulators, perhaps under 45. Smaller client portfolios by size, relatively simple requirements, just quite keen for market exposure and keeping costs down. So those are your sort of simple needs or wealth accumulators. Then you've got your central retirement proposition. So that's including those approaching retirement, those in decumulation, and those that want to perhaps have some legacy planning. And then the final one is those with more complex needs that have perhaps varying goals, to perhaps high net worth clients, or they have specific needs like income or sustainable requirements. And I've given an example here. You then decide of the providers that you like, what portfolios or what provider kind of fits in those three buckets. So, for example, put here a multi-asset fund for the simple needs, perhaps a Vanguard Life strategy, and then a passive MPS solution such as our passive solution. For the core elements for the central retirement proposition, we will go into this a little bit. I've given three buckets here. And then for more complex needs, a sort of core MPS, perhaps over a passive that perhaps can weather various different environments a little bit better. So perhaps you have two MPS providers that kind of work well here. And then you perhaps have a DFM that you kind of rate highly for anyone with particularly complex needs that sit on the shelf. So that's the sort of blueprint that we kind of, when we're working with firms in putting together a CIP, we tend to kind of base it off a blueprint, kind of quite like this. So I'll pause there briefly in case there's any kind of questions before kind of going into a kind of quick case study on a central retirement solution. So I'll just kind of pause there in case there's anything particular. I don't think there is at the moment, but please jump in. Okay, so moving on to the central retirement proposition. This is a really kind of big area at the moment. Obviously, a lot of clients fall into this space. What we've found is that there isn't an exact central retirement kind of solution. We're not finding that everyone's falling into this one camp. I see such a spectrum of CRPs, and we spent a lot of time speaking to advisors, understanding the market, understanding the regulations around things, and so we've kind of come up with a bit of a blueprint for a CRP. But in our view, a CRP needs to be simple, versatile, reliable, and repeatable. Simple for clients to understand, versatile to allow for varying client and changing client needs, because not everyone in retirement has the same needs. Some might have wealth elsewhere. Some it might be they need to utilize all this pot. Some might have some legacy planning and these sorts of things. It needs to be reliable. You need to have confidence in it, and it needs to be repeatable. So it needs to be kind of repeatable across the client base with different requirements over time. So I think those are the 4 key hallmarks of a CRP. And then you can kind of bucket a CRP or someone in retirement into kind of 3 investment pots: liquidity, lifestyle, and longevity. So your liquidity pot is those short-term cash needs. So you're probably 2 years worth of cash that people need. They don't want any volatility in that. Highly liquid. They can get access to in a day and these sorts of things. And this helps. This is the start of the avoiding of sequencing risk as well. The next stage is your lifestyle pot. This is your sort of 2 to 7 year pot. Again, you probably wouldn't want too much volatility here. But so this is aligning the strategy with the client's current or planned desired way of living. And this also helps a little bit with the sequencing side of things. And then your longevity part is both the longevity of the pension, but if there is a plan to leave some legacy, it is also included here. And here you're able and willing to take a little bit, well, quite significant amount of risk, perhaps 80% equities or something like that. And that is that sort of growth pot, so that the pot has some longevity. So this is kind of our blueprint for CRP.
That point as well. This is something that's come up for quite a lot of conversation with firms recently, where they've maybe looked at sort of centralised retirement propositions, or even a lot of them that we're getting asked at the moment is sort of saying, how can I compete with the discretionary managers, the private banks, the multifamily offices? That sort of bucketing approach around the lifestyle, liquidity and legacy pots is what 9 times out of 10 a lot of those people do. So it's really helped them actually now increase the quality of client they're looking after and compete with some of those offerings at a much lower cost. So it's really helping them attract more high net worth and ultra high net worth clients, especially those that are looking at retirement solutions or sort of legacy solutions.
Yeah, absolutely. So looking at these 3 pots in a little bit more detail. So the liquidity pot, this is a low risk pot, largely cash based solution. So you get kind of cash rates off this, which is pretty decent at the moment, 4.5–5%. And so I'll just kind of dip into our solutions. So we've got our cash plus satellite portfolio that clients use for that. So it provides liquidity, stable capital, returns close to base rates. Then your next is your lifestyle pot. So you're kind of lower risk here, probably looking for 6 to 7% per annum, sort of low to medium risk profile. And for us, we have a 4 seasons portfolio. So this is a really, really great portfolio that has a good 50 years worth of data behind it, in terms of it's quite similar to the hallmarks of the Bridgewater all-weather strategy. So it really provides that inflation proofing and things over time. And then you have the longevity pot. So you're really looking for that 8 to 9% return from this pot. And so you're perfectly fine using a passive based solution here for that long-term pot. So I put in here the Aspen Growth Passive Plus portfolio. And so these are the sort of 3 pots, and I've given 3 examples of portfolios that we use for clients to kind of build that. So now I'll give a kind of example of the CRP in practice. So let's say we've got someone in retirement. They've got £1 million pension pot. They're age 70 and in good health. So their expected time here period is 20 years, and they're medium risk investor. Their requirements is they would like 50K a year gross from the pot growing with inflation. They'd like to avoid sequencing risk and significant volatility, and they would like to leave some legacy to children. So this is a fairly typical client. So the solution, so we provide some useful tech so that you can kind of tailor this a bit and give a nice clean kind of output to clients. But what we're suggesting here, kind of as we've discussed previously, is we'll have 10% of that, so 2 years. So that's 2 years worth of that income, so £100,000 in that liquidity pot, so £100,000 in the cash plus portfolio. The next 5 years, in the Aspen Four Seasons portfolio, for example, or another equivalent version from another provider. And then the longevity pot, so the next 13 years beyond that, is in a sort of growthy passive-based portfolio. So what you've got here is a really nice clean solution. All-in cost of this is around 37 basis points versus, a discretionary or a solution which would be probably well over 1%. So you've delivered this custom solution specific for the needs of this client using the building blocks of model portfolios in a really clean and efficient manner. And each year, you can simply, if the circumstances are the same, a year down the line, you can just top up each pot. So some of that money in the growth passive falls into the Four Seasons, and the money in the Four Seasons goes into top up cash, and that can just repeat every year. So it's a really nice, clean solution. The client feels really comfortable, and it's really important, I think, to avoid financial anxiety for the client as well. When they're in retirement, they want to enjoy their retirement. I have seen a few solutions that are 1 year's worth of or 2 years worth of cash and then really an equity mandate. My personal view is that's probably a bit too much financial anxiety for the client. It's fine when things are going well, but it's not inconceivable that equities have a 40% drawdown. I think that would cause quite a lot of anxiety for someone in retirement. So I think you need that middle section to help buffer, but still generate a decent inflation-proof return. So that's kind of the blueprint that we have for a CRP. Just for any questions there on CRP, and Lewis is just going to do a 5-minute demo of how this all kind of fits together using our tech before any final questions we wrap up with.
You must be answering all the questions as we go. Andrew, you must be.
Or everyone's so hungover they've gone to sleep. Lewis, can you share again?
Yeah.
Do I need to stop?
Can we see my screen now?
Yes.
Cool,
Okay.
perfect. Yeah, so what we're going to focus on...
I can't see your screen at the moment, mate.
You can't?
No, I've still got Andrew's screen up.
That's weird. I'll stop sharing. That might help.
There you go. Now I can see it.
Yeah.
There we go.
Sweet, perfect. Yeah, so one of the things that we come up again, time and time again, and this is what people are wanting to really do with their sort of CIPs and CRPs, is how can you then deliver that in a really efficient way? And technology can be your friend and really help you out here. So we've basically built this system called Portfolio Discovery, which can effectively align your risk profile with your CIP all in one place, which means that you can then create nice tailored reports for clients that basically meets their needs, whilst it's aligned obviously to your own processes and systems as well. So if we then just say there's 2 journeys you can do. If you wanted to uncover what portfolio is actually best for the client, you can do portfolio discovery. But for the purpose of time today, we're just going to go through portfolio selection using the example that Andrew's just walked through. So we're going to say that I'm the advisor today and Lee's going to be the client. And what we're going to look at for Lee is that example we just looked at there, which is his retirement plan. So you start off by putting a tax wrapper. Let's just say, for argument's sake, it is going to be £1 million and it's going to be all in pension assets. You can then align the risk profile with whatever you use. So we also have a risk profiling system you can use, but this is a mapping system that helps you map whatever one you're using, whether that be an e-value, de facto, etc., whatever it may be. So let's just say this client is scored medium risk, and that's been mapped from de facto as a good example. We can jump straight into building the solutions. So there's one of the solutions we want to offer this particular client to keep costs down is going to be the passive solution. Now, in most traditional cases, it will then say, well, the balanced passive plus portfolio is going to be the solution for you. But as we've just alluded to there, we're going to want to do a little bit more for this client because this is a retirement client and we really want to do things like avoid sequencing risk and give them less financial anxiety, as Andrew mentioned. So we're going to start off by having a growth passive plus portfolio. We're then going to add the capital preservation portfolio for that sort of medium to short-term horizon instead of sort of 2 to 5 years. And then we're also going to add in that cash plus portfolio we mentioned there. So let's just say in the capital preservation, we're going to put £200,000 in capital preservation. We're then going to put £100,000 in cash gilts, which then leaves us with the growth passive plus at £700,000. So what we've been able to do is effectively see what the effects of combining these solutions together has done to the client's aggregate risk. And actually, if we were to say, let's just put in the balanced passive plus portfolio we were initially looking at as a good example for that majority of wealth, what it will then do is, as you'll be able to see, is show you that you've actually gone below the client's sort of aggregate risk level. So you've gone from a 3 out of 5 to now it's dropped down to a 2.4 out of 5 instead. So this is where the tool can really help you look at what solutions are best and whether you can potentially take more risk, especially with the longer term pots in here instead. And it just helps show you what the effects of combining different solutions together can do to really tailor the client outcome. So you can put some notes around in there as well, saying obviously that long-term pot's going to be growth passive plus, medium-term pot's going to be capital preservation, and then short-term is going to be cash plus. And what it will do for you at the end is produce this in a nice client-friendly report, which talks through the process you've just gone through, includes any notes, and gives them the fact sheets. So the client's effectively then got something that they feel is more tailored for them, and you've been able to use the building blocks of model portfolios in this particular case to create something more tailored for the client without having to be a manufacturer of a product and effectively having to go sort of build your own portfolio to get it more bespoke for this particular client. So this is just a bit about the reports to talk through any notes. You can see the bit where I've got here about match risk from de facto. You've got the recommended portfolios here, and then you've got all of the portfolio fact sheets to detail as well. So yeah, just really nice streamlined way of bringing your CIP together whilst also aligning it to your risk profile as well and giving the client that they feel something's got more tailored for them.
Thanks, Lewis. And I would say that the software is completely white labeled. So that was obviously in the Aspen brand, but for farmers, that's completely white labeled, including the fact sheets, the reports. There's no sign of a kind of Aspen in there, other than disclaimer. It's that's kind of there's other functionality around there, but that kind of gives you a flavor of how tech, and it's not, there's hopefully some other providers out there that provide good tech experience as well, but a good journey and experience in investment selection, I think it's an important part of your CIP as well. So that's kind of it from us in terms of things. I think we've got 5 minutes if anyone wished to talk about anything, ask any questions, or not.
Yeah, absolutely, guys. If you've got any questions, please fire away. If there's a part of the tech that you want to see, ask the guys. I'm sure they'll be more than happy to show you any part of the tech. But it's been a pleasure having you all join us today. Absolutely pleasure. It really is. And you'll also get a recording of the webinar as well. And we'll also pop on Andrew's and Lewis's contact details should you wish to make contact and have a chat with the guys and find out a little bit more about Aspen. That'd be perfect.
Quite understandable. It's the Friday before Christmas, and everyone's got things to be getting on with. So not to worry about necessarily questions at the moment, or we've just done an incredible job about explaining the best CIP there is. So thank you, hugely from Lewis and I today for joining, and we wish everyone a very happy Christmas.
Absolutely. Well, look. No attendees have left. No attendees are asking questions. We need to ask if they're still awake. Are they still with us? Are you still with us? No, guys, look, it's been an absolute pleasure. Again, Merry Christmas from everybody here at the club as well. And no doubt we'll speak to you all soon as well.
Merry Christmas, everyone.
It's been a pleasure. Thanks, guys.